was an interesting Forbes article earlier this week that asked is Taylor Swift a brilliant real estate investor? The article said Swift has accumulated several properties across New York, totaling nearly $50 million over the last 6 years. According to analysts, the pop star appears to have a sharp sense of investing. But enough about real estate in Lower Manhattan. Let's bring the conversation back here at home, where the real estate market or industry has been enjoying what some are calling its longest winning streak. What's hot and what's not? Joining us this morning, Roi Bondoc of Colliers International Philippines. Joey, thank you so much for joining us. Good morning. Yes. So let's start with 2018. How was 2018? We did see 175 basis point increase in the policy rates. Yeah. Pretty aggressive.
Yes, I agree.
Did you get affected?
Well, surprisingly, the Philippine property market recorded record highs in 2018. Wow. I mean, in terms of office, we saw record high supply and demand, net take-up, meaning more offices, more companies absorbed office space across Metro Manila. For the residential sector, we saw record high take-up, meaning more units were bought in the pre-selling market. Surprisingly, the leisure sector also recorded record highs, 2,800 rooms, new rooms completed in Metro Manila in 2018. So it's a year of record highs for the property market in 2018.
Why do you think, sentiment for this real estate industry was not dampened by the increase in interest rates? Because that's what we always say. The property sector is always very interest rate sensitive.
I agree. It is interest rate sensitive, but I think if you look at the property market in general, it is being driven by a sustained macroeconomic environment. I mean, we still have an economy growing about 6 to 6.5% per year. And if you look at the residential sector, the interest rates really kick in 5 years after your down payment period for your condo unit. So for a lot of buyers, they are optimistic that interest rates will still be sustained over the near to medium term. There will be no major spikes. And surprisingly, again, for the residential sector, buyers continue to take up condo units in the pre-selling market. Even those in the secondary market or the condo units that were completed already, there was a strong take-up. And we saw prices of condos in Rockwell, in Makati, in Fort Bonifacio, increasing by about 100% from their launch in 2012, 2015. And that is pretty good news for the real estate sector in general. So.
Very interesting that you mentioned a lag effect. For those buying residential properties, there's a 5-year, usually the interest rates kick in. That's true because first it's in-house financing.
That's right.
And then after the 5 years,
bank financing
it's bank financing. That's when you get hit by interest rates.
Yes.
But so when do you expect that lag effect to be felt? Or do you think by that time, the central bank has pulled back the rates enough
Exactly,
to offset?
especially with the central bank's recent movement, right, to cut interest rates. I mean, there's an immediate effect, definitely, for the property sector, especially now that the central bank finally cutting rates by 25 basis points, and we might see another round over the next few quarters. And I think what it affects really are the speculative buyers. But for those who are making their second, third purchases already, they're pretty much aware of what's happening in the property landscape in general. So they believe that this will not have a very large impact on spikes of interest rates over the near to medium term.
So let's talk about what's hot and what's not. So what's hot for 2019?
For 2019 in office, we're seeing flight to quality movements from occupiers. See a lot of BPOs, KPOs. These are discerning occupiers, Google, Amazon, and they are requiring quality office space and larger floor plates. So what they're doing now is previously, they were in buildings completed 2013, 2015. Surprisingly, they're now transferring to buildings completed 2018, 2019. These are LEED certified buildings that are environmentally sustainable also. And we see a lot of discerning KPOs occupying more space here in the Philippines. Overall, we have a good macroeconomic environment, and the traditional companies that are here in the Philippines are occupying more space. We mentioned that the government's build push is also contributing to higher office space take-up because the government's push to really build more infra outside of Manila, for instance, have been compelling these companies to occupy larger space. So that contributes to a greater office absorption here in Metro Manila.
For those BPOs, for the many of the big companies, you did say the flight to quality. What happens to the buildings, the older buildings? Is that a good thing? Because it pretty much tells you the turnaround time is getting shorter.
That's a good question, because especially for older buildings in Fort Bonifacio, for instance, we're seeing some difficulty in terms of filling up the space. But based on what we see and hear on the ground, there are a lot of live transactions, meaning some government agencies, for instance, or traditional companies, non-BPOs, are looking at these office spaces. And while there is a marginal increase in vacancy overall, again, because of these pockets of vacancies in some buildings, we see this space being filled up over the next 12 to 24 months. So it's still a pretty good vacancy for Metro Manila overall.
So who's driving this real estate boom? Is it still the Chinese, the POGOs, BPOs, or are you seeing a new breed of driver?
You know, Mimi, perhaps 3 to 4 years ago, I'll tell you that 60 to 70% of the office space is occupied by your BPOs, KPOs, the call centers, right? But right now, starting 2016, fourth quarter, with the influx of POGOs, we saw a diversified demand generally. So you now have 30% occupied by BPOs, 30% occupied by your offshore gaming companies, and then the remaining 40% occupied by your traditional companies, insurance companies, flexible workspace operators, another new player in the market. We also see fintech, financial technology companies that could drive demand in Metro Manila moving forward. So pretty interesting demand all over.
So you have a very extensive report. I wanted to go over some interesting slides.
Sure.
Let's start with page 23 of that slide, prime office rents in key Asian cities. We're still very cheap.
I know.
if we could show the graphic there, we're very cheap.
Yes, that's right. We're still relatively cheaper across Asia Pacific. We covered also some Australian cities. So we're still a part of the bottom 20%.
We're the yellow line there.
Yes, that's right. And still one of the cheapest. And you have to note that that's one of the reasons why the Philippines remains a very attractive location. Of course, apart from manpower.
There's a reason why we're cheap. Why are we cheap? There must be a reason.
Well, because if you look at the overall supply of Metro Manila, it's still not large. I mean, compared to the other markets in Southeast Asia and Asia Pacific. Plus, of course, some Chinese occupiers or tenants, for instance, have been occupying office space in other key Asian cities, and perhaps the POGOs are just the first wave of office occupancy in Metro Manila. So we don't know. We might see new locators moving forward. So it's a matter of supply and demand. Once we see more demand, of course, prices or lease rates will definitely go up.
Okay, next slide, page 41. We're seeing slower pre-selling launches and take-up in residential sector.
That's right.
So we're seeing signs of a slowdown?
Not necessarily. We noted that, again, in 2018, we recorded the record high take-up, 54,000 units in the pre-selling market. We mentioned during our fourth quarter briefing that a major challenge for the residential sector is that the slower launches, because of lack of developable land and higher construction costs, might dampen total launches in Metro Manila. So still, from 54,000, we still estimate a 45 to 50,000 take-up in the pre-selling market. Again, if we factor in, of course, the slower launches because, again, of lack of developable land, that will definitely be a concern.
How about this? Page 32. The Bay Area still covers 50% of new units completed in the first quarter. There's so much interest in the Bay Area.
I know.
Of course, this is with the DM Wenceslao group.
Yes, a lot of projects in the area. We now see prices in the Bay Area at 250,000 per square. Wow. I mean, previously, those are rates that you'll only see in Makati and Fort Bonifacio. But due to the strong demand, again, from POGOs, as well as local and foreign investors, prices have really gone up in the Bay Area.
And page 33, Fort Bonifacio, accounting for 30% of new supply in 2020. Is Fort still the place to be?
Yes, it is. I mean, of course, given its proximity to Makati, it is still a very attractive location here in Metro Manila. And though I believe that the completion of condo units in Fort Bonifacio is simply complementing the pace of development of office towers in the area. So office and residential completion are complementing each other.
And page 37, you did share condominium prices.
Yes.
on that page. So how is investments in condominiums, basically?
Well, condominium investment has really been firm. If you look at after the global financial crisis of 2008, prices have not really gone down. They have plateaued for 12 months perhaps, but after that, the prices have continuously gone up, and now we see tremendous increases in prices. We do not see a slowdown, again, because of the strong demand from foreign and local investors. So that should really sustain the property market in general.
Final question, one-word answer. If I have money now, where can I put my money? Where should I invest it? Where it's still cheap, not too high, but you're seeing great potential.
Look at the townships in Metro Manila, integrated communities. Yes, where there is office, residential, malls in a plot of land, because that's where we see a greater capital appreciation moving forward.
Okay, on that note, thank you very much, Joey, for joining us. Great to have you on the show.